So what makes a great investor? Well, just do it like me. No, I'm just kidding. No, but in all honesty, I have learned a lot in all my years of investing. So today you're in luck as I bring my knowledge to you. Now stick with me as I share that most misunderstood characteristic that makes a great investor. Okay, so number one, investors have rules, not guidelines. You guys ever watch the Pirates of the Caribbean, that movie? When Captain Barbossa, he's talking with Elizabeth Swann, and she's saying, well, the Pirate's Code. He first says, first, you're not a pirate, so it doesn't apply to you. Second, the Pirate's Code is not so much rules as they are guidelines, right? You remember that quote? That is a big key difference. Gamblers have guidelines. Investors have rules. Investors realize, hey, if this happens, this has to be the result. I do not break this rule. Rules do not get broken. Guidelines are just rules of thumb. They kind of work, but you're a little flexible and your emotions can get you to break them. But rules mean this will never, ever be broken. So for example, many times when I was teaching people how to trade stocks and options, we would have people set rules first. And we even gave our own rules. Rules like take profits high, buy low, sell high. I mean, kind of dumb, but it's true. But also let your profits run, but then cut your losses short. So if the market started to go down or the stock started to go down, you pulled out quickly so you didn't lose too much money. Because heck, even if you had 3 trades, 2 of them lost money, but 1 made a good amount of money. If you had small losses, but then you had a really big gain, you still made money even though you only were right 33% of the time, right? So those kind of things. Or other rules like don't trade on hot tips. So don't listen to Mad Money. By the way, actually, in general, just don't watch the news, okay? None of that will make you a good investor. Don't listen to the news and what they're telling you, because almost anything in the media is usually already been in the past. Whatever was hot is no longer not, is now not. So if you hear it's hot, it's not anymore because you've heard about it. So don't follow the media, don't do those things. So make sure you have hard rules and not just loosey-goosey guidelines, right? Number 2, investors take out the emotion. Now, I don't want you to become Spock, right? I don't mean you have to be a complete jerk, But the truth is that emotions can get us to do dumb things, right? I mean, it's no surprise. I mean, you go to the next room over here, my wife's in there. She knows what happens when I get emotional. When I get emotional, we're in a heated debate, I get stupid, right? I get dumb. I say things I shouldn't ever say. I say things that get me a sore back sleeping on the wrong kind of bed or couch, right? That's what happens when you get too emotional. Same thing is true with your money. You don't want to get kicked out and living, not in your house anymore. Maybe you're living in a cardboard box because you lost a bunch of money. Investors don't do that. Investors actually like to take the emotion out. They try to make real rational decisions based on what evidence is there, right? They want to see and know that they know nothing's risk-free, but they do know that they can mitigate that risk. They can do the different things that can make it work in their favor. So take out that emotion. Number 3, don't follow the crowd. It's kind of like don't trade on hot tips, right? Don't follow the crowd. If you hear everybody telling you to buy into the stock market that it's making money, that's the time not to be in the stock market. If everybody's saying buy real estate, that's not the time to buy real estate. If everybody's saying buy crypto, definitely not the time to buy crypto. I remember a few years back when Bitcoin was hitting its big run at one point and it was going crazy. And then I had a classmate from my high school class that I know she knew nothing about investing saying, hey, I've heard about this Bitcoin. Who wants to buy a Bitcoin with me? And she's like, and by the way, how do you buy a Bitcoin? That is when you know the price is too high and it's not the time to buy or invest, right? That's exactly what happened. It crashed just the next month after she said that. When you start hearing your taxi cab driver giving you advice, that's the advice you pretty much, or your Uber driver, don't take their advice, right? Don't follow the crowd. In fact, often the best investments are the ones that everybody's saying get out of. The best way to do this is that when you know everybody else is running away, that's the time you run towards the danger. You run towards the thing that nobody wants anymore. That's why, believe it or not, that's why I'm actually still doing real estate, because people are still scared of real estate even after 2008. It hasn't even been that hot. It hasn't even had a chance to be that hot. So I've been running towards real estate. I've been running towards things like oil and gas after they almost crashed a few years ago. I've been running towards that kind of stuff to be able to make more money because everybody's running out of it. Now, I guarantee if people start telling me, Chris, stay away from the stock market. And if everybody's saying, even if that same high school friend saying, stock market's risky, don't buy that. That might be the time you'll actually see me buy into stocks. I know, shocking, because I hate stocks so much, especially when I hate on them so much, right? Well, that's the truth, is that sometimes I like to buy in. Did you know, actually, after my friend tried to buy that Bitcoin, and then of course it crashed, and it started crashing, and everybody went quiet. All the people are saying, I'm making so much in Bitcoin, and then are losing tons of money. Guess what? When it got really low, that's when I bought some. Now, I didn't buy a lot. I managed my emotions. I bought very little, but I bought some. I bought it was like $6,000. Well, it took off. And after it took off, and then when everybody said, I want to buy it, I said, great, this is the time I need to sell. Because everybody wants it. When dumb money goes in, that's when the smart money comes out. Vice versa. When the dumb money comes out, the smart money goes in. So don't follow the crowd. Number 4 is focus on real assets. Now, I'm talking about like digital currencies and stuff. That's not a real asset. And when I say real assets, I mean like tangible, real property, real stuff. I mean like real estate property, real assets. Even business to some level is a real asset, although that's kind of in between. But real assets are things that have real tangible value to them. Hard assets, as some will call them. That's what I like to invest in. I focus more on those, especially, and here's a bonus, especially those real assets also pay passive income. Because at the end of the day, I don't want just a bunch of assets. I want assets that pay me money, so then it's working harder for me. I want my dollars doing all the work. I want my dollars to be employees. I want my little Franklins out there doing their hard little work, working on the railroad all live long day and helping me make money in things like real estate. So real investors focus on real assets. They focus on hard assets. You'll see that more millionaires are made all the time, more made in real estate than any other business and any other type of investment. Definitely not mutual funds. You won't see people bragging that they've made millions in mutual funds. There are some that have done it, but it's much, much harder and a longer path than if you did it like in real estate, for example. So I focus on those kind of assets, things that I know won't fall to zero. I can't trust that a stock won't fall to zero like it did with the Enron or the WorldCom days. If you remember during Y2K, we saw lots of things. Bear Stearns, another great example. Heck, even Jim Cramer, I said, don't listen to that hot tip, right? Jim Cramer said, don't sell Bear Stearns, buy it. And what happened? Days later, tanked, it crashed, right? Again, those are the things that I don't like to put my money into. I like to put my money into real property, real assets that also pay me cash flow. And then the last but not least that I think makes an amazingly great investor is that great investors take less risk. There's a false belief, a myth out there that says that you got to take high risk to get high returns. The truth couldn't be farther from that story, right? That's a complete lie. Think about this. If high risk, which is chance of loss, creates high returns, that means the bigger the chance of losing, the bigger chance of winning. The less that means if I have a 10% chance of winning, does that mean I have a 90% chance of losing? That doesn't add up, right? A 90% chance of losing does not equal a 90% chance of winning. Take less risk. We like to manage risk. Now, there's nothing that's risk-free. Even a savings account has risk, right? There's even risk you could lose your money in a bank, right? Those things can actually happen, even if they're very far and distant. Real investors, true investors that are smart and make millions of dollars, they know they want to take less risk. They want to mitigate that risk to as close to zero as they can get, so then they can let the returns take off. I like low risk, high returns. Again, why focus on real assets, right? That's why I focus on that. I take less risk. Even people say, oh, you do real estate? That sounds risky. Well, not if I do this. Not if, for example, one, I don't manage the property. That's a good thing because I can be a pushover sometimes when it comes to property management. So I get a property manager who's willing to hold the line, make sure I get paid. Two, when I deal with properties, I also buy in multiple markets. I don't just buy in one place. And I especially don't buy in my backyard. I buy in places where I already know. Three, I buy the property, I know how much money I'm gonna make before I even buy it. And then four, I also try to make sure that I have all the conditions done before I buy the property. We do little things like inspection reports, make sure that the property's not gonna break on me. We make sure we have a tenant in place. We make sure all these things are in place before the property closes so that we make money right off the bat. Those are things that do less my risk. So with most average people say, well, I gotta fix up a property and put lots of money into it. Then I have to find a renter if I'll find a renter. And what if the rents aren't high enough? Yeah, you're right, that's risky. That's a gambler. But me, I like to take as little risk as possible to get the maximum returns I can possibly get. That is how you can do it. That's what investors do. So to recap, what investors do, they have rules, hard, firm rules that they follow, not guidelines. Two, they take the emotions out of it. 3, they don't follow the crowd, which help with the emotions. 4, they focus on real property, real assets. And then 5, they take less risk. Hey guys, if you thought this was great, check out this next video, how to make $5,000 a month in passive income right now.